Here is a collection of best practices. Value investing is buying an asset at a discount to what it's really worth. This gives the buyer a margin of safety. The first step to making an investing decision is to develop an understanding of what we are buying. Rule number 1, never lose money. Rule number 2, never forget rule number 1, said Warren Buffett. Value investing is different from speculation. Benjamin Graham defined the differences this way. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Successful investors and successful speculators do have something in common. They study their prospective investment and base their decision on collected information used to develop their understanding. Speculators look for assets that could have a greater value in the future, depending on events. In contrast, value investors seek to buy businesses at substantial discounts to their true value today. Value investing depends on the estimation of intrinsic value. Thus, that value estimation is an important process. Weighing and thinking about both qualitative and quantitative factors make this a better valuation. Successful investors and successful speculators believe that mispricing creates a profitable opportunity. A short term of bad news, misfortunes of a company, good news that hasn't been widely recognized, or a market-wide stock sell-off, can be times when the stocks of good companies are priced at a discount to what they are worth. Investors use several different methods to estimate a company's intrinsic value. A simple shortcut that many people use is to start with the company's price-to-earnings ratio, or P/E ratio. That is the ratio of earnings per share to the company's current stock price. Since the P/E ratio can be manipulated, a better approach is to think of a P/V ratio, a price-to-value ratio. Competition is a major force on a business earning potential. Thus, it must be evaluated carefully. Seeking a business with an enduring competitive advantage is important. Evaluating a deteriorating competitive position is therefore very important. We might also look at other price ratios like price to cash flow or price to sales, and see how these compare to rivals. However, a big picture approach of evaluating efficiency and endurance is probably a better approach. Awareness of a potential value trap is important. Great short-term numbers may motivate some to buy a deteriorating business. Evaluate the ability and trustworthiness of managers. Since they steer the future course of the business, both elements are very important. Managers who are not trustworthy can add large costs and do great damage to a business. Think like a business owner. Study the company's management team and see if their incentives are aligned with shareholders. Great business managers tend to have a sizable amount of stock, or stock options, in the business. Value investors should seek a margin of safety. The difference between a stock's intrinsic value and its current market price is the margin of safety. Buying at a margin of safety price adds a certain percentage increase to the annual returns obtained from positive profit growth. The key to value investing is to find stocks with a good margin of safety, or put another way, plenty of upside potential. Seek an adequate return. An adequate return is a return that a reasonably intelligent investor is willing to accept. How do we find businesses with a good prospect and a good margin of safety? Read and think. Warren Buffett said, "If I were looking at a company, I would put myself in the frame of mind that I had just inherited that company, and it was the only asset my family was ever going to own. What would I do with it? What am I thinking about? What am I worried about? Who are my customers? Go out and talk to them. Find out the strengths and weaknesses of this particular company versus other ones. Experience matters." Buffett said, "When you invest, focus on your circle of competence. Draw a circle around the businesses you understand and then eliminate those that fail to qualify on the basis of value, good management, and limited exposure to hard times." Another metric that can help is the price-to-book ratio. The book value is the business total assets minus its total liabilities. If you find a company trading for less than its book value, you may have found a company that you can buy for less than its assets are really worth. Apple in the fall of 2003. Be careful. The price-to-book ratio doesn't work well as an absolute measure. Two very different companies can have different price-to-book ratios. Tech companies often trade at many times their book value because software assets may have intangible value that has more or less potential earning power. Automakers tend to trade at low multiples to their book values because their factories are highly valued. So, think about a business' reasonable earning power within its competitive environment. Spend some time learning about the business and its competitive situation. Use time to your advantage. Think in terms of years. Warren Buffett said, "The stock market is a device for transferring money from the impatient to the patient. The market is usually efficient over the long run. Eventually, a stock's price will reflect the company's true value." Think independently. Value investing sometimes requires a contrarian mindset. Mispricing can create a buying opportunity when a business stock is wildly out of favor. Be the investigator. Successful value investing may mean taking views that are at odds with conventional wisdom, or with the opinions of other experts. Read the company's annual report and keep an eye on news pertaining to the business and its competitors. Reevaluate your thinking. Do you still have a good reason to own stock in the business? If you can't beat the market as an active investor, you're better off buying an index fund and doing something else with your time. Sometimes, inactivity and quiet study is the best course of action. In my view, the search for a great investment should focus on a high-quality bargain, HQB. This involves careful thinking about qualitative factors and quantitative factors. Value investing can be viewed as a simple four-step process, thanks to Warren Buffett. He said, "Charlie and I look for companies that have, 1. A business we understand, 2. Favorable long-term economics, 3. Able and trustworthy management, and 4. A sensible price tag." After a few years of buying mediocre businesses, he learned to filter out the less profitable ones. After many years of reading, studying, and owning bad, mediocre, and good businesses, he and his business partner Charlie Munger kept on learning. In value investing, how do we add to our knowledge? My first suggestion is to read summaries about the greatest investors of our time. Then move on to the historical great investors. Read about their record of winning and losing investments. We can learn a lot from studying losing investments. Along the way, we pick up more facts and insights that build up our knowledge. Charlie Munger calls this his lattice work of mental models. Our main goal is to find HQB, a high-quality bargain. The bargain is that difference between the market price and the intrinsic value.